Good afternoon, ladies and gentlemen. Welcome to our first quarterly update for 2024. Before we dive in, just a few housekeeping rules here, just to make sure everybody's on the same page, and a few compliance bits here to go over as well. So the webinar will be beginning shortly. We will have a dedicated Q&A section towards the end, so please save your questions for the Q&A section. Alternatively, just please feel free to post them in the chat, and if relevant, we will make sure to get to them as we go through this session today. And a few compliance bits here now to go through. So information presented is for educational purposes only and is not meant as a solicitation or offer for any specific advice or investment securities. Please be sure to first consult with a qualified financial advisor and or tax specialist before implementing any strategies discussed herein. And with that out of the way, I will hand it over to my colleague Isa, who will be going through a few planning items for 2024.
Good afternoon, everyone. Yeah, so I'm going to start off with a couple of adjustments or updates the IRS has posted for 2024 in regards to the contribution and deduction limits. So like every year, the contribution limits for retirement accounts like IRAs, 401ks, etc., have been increased a little bit. So this year we can contribute $500 more to an IRA, which makes this a total of $7,000. If you're over 50, you can add another $1,000 of catch-up contribution. Now, for all the other retirement plan limits like 401k, 403b, and these kind of plans, you can find the details on our website's blog or on the IRS website. Now, another thing is required minimum distributions. So if you already are over the age of 73, you will know those, probably, hopefully. If you reach the age of 73 this year in 2024, you should be taking your first required minimum distribution at the latest by April 2025. In the first year, you have a little bit more time to take this distribution. For all the others and all the consecutive years thereafter, you have to take your distribution by December 31st. So make sure that you keep that in mind and take that into account when planning your financial year. If you inherited an IRA, the rules are a little bit different with the distribution, especially if you are not the spouse of the decedent. You have two options, or generally it depends on when the person passed away. So there is the option of stretching out the distributions over your lifetime or taking it within 10 years. If the original IRA owner has passed away after December 31st, 2019, then you do have to take the distributions all within 10 years. You can either phase this out over 10 years in tranches, or you can take a lump sum in the last year. But keep in mind that the more you take, the higher the taxes will be, since you could enter a higher tax bracket depending on the amount of the IRA. Now, if you want to donate, or if you do donate to charities, you can also benefit from a tax deduction, which starts at the first dollar, and the deduction has now been increased to up to $105,000. So that is the maximum that you can deduct from your taxes in donations. Make sure that you always ask for a donation receipt if you don't get one automatically. That is important for any donation over $250. For anything smaller, all smaller transactions, keep a record of that. Make sure you have a bank statement or anything like that to show that you have made that donation. Now, this year is an especially odd year with the election, and we have reviewed a couple of congressional bills and have decided to highlight 3 of them, which are most relevant for US expats. Brian will give you a little bit more details on those now.
Thanks, Isa. In a year with 70 elections, we're going to highlight politicians that are not on the front line. we've got Dina Titus, Don Bayer, and Carolyn Maloney up displayed on your left-hand side, 3 congresspeople that actually highlighted bills, or sponsored bills, I'm sorry, that are there to simplify our lives as American expats. So what we really wanted to highlight, these are in the last year, we do have congressmen and congresswomen that are actually trying to make it so that every single bill will actually have to be investigated of how it would affect American expats. That's the first one. The second one is going to simplify the tax filing for any American overseas. So there would be a standardized form instead of a full declaration. And the third one would actually include a same country exemption. So anything happening in that country you're resident in would be exempt from the American tax system. Now, for any of you that don't remember Schoolhouse Rocks, the nice little jingle about it just being a bill, these are all just bills. They need to get over a lot of hurdles, and they could use all of your support. So these 3 individuals introduced the bills. They're by no means laws, but we would love to see them become laws. So if we go to the next slide, what I'd like to remind you of as we go into this political season, don't just let the Trump-Biden aspect of things drive you nuts. This is the part that you can try to help yourself. Find your congressman or congresswoman or anybody that's up for election. You can find it right at this link down below, and make sure you write to them to support those 3 bills. They're nonpartisan bills that will just help all of the 5 million plus American expats out there in making our tax structures much easier. And all of these links will be available in our follow-up email and directly in the YouTube following up this presentation. But in this political season, that becomes so important, and these are 3 that are highlighted. The other link is for AmericansAbroad.org. This is American Citizens Abroad. Essentially, their advocacy group helps in trying to get the word out and making sure that we're writing to our congressmen. If you want to volunteer with them, there's plenty of opportunities there, or reach out to me directly. If you struggle on this, please just reach out to me. These are the important things for voting, instead of whether Trump or Biden are going to be president of the United States, and we'll get to that later. Now, getting off my soapbox, let's get onto another soapbox, Cam, and let's talk about the economy and what the market might be doing in the next year.
Absolutely, and thank you very much for that segue there, Isa, on the planning aspects for 2024 that clients should be keeping an eye on, and Brian for that wonderful summary of some of the sort of gems in the rough that some of our politicians are working towards to make American expats' lives a little easier. But with that said, as we move on to the agenda, I think the main overarching question on everybody's mind is the stock market overvalued? How is that going to affect our portfolios with the election, dovetailing that into the conversation, and many other things that we'll be covering today. But before we actually jump into some of those items as well and discuss that, why don't we just take a step back and look at what's actually going on here? So why don't we break down, Brian, how this picture has anything to do with what we're discussing, and B, going forward, is the stock market actually overvalued?
That is the ultimate question right now. And first, I'll give a few different ways that we look at valuing stocks, and none of them are the epitome of everything, because they're all on the baseline of long-term moving averages and using this fictional character of Homo economicus being the most pragmatic, rational human being. And yet there's 8 billion of us out there, and none of us are like Homo economicus of being constantly pragmatic. The baseline of how do we evaluate the stock market is looking at how much money a company is actually earning versus what the current price is. Now, even further than that, the hailed economist, Mr. Schiller, from Yale actually expands on that to say, what happens if we take the 25-year moving average and we adjust it for forward-looking earnings, and we also look at inflation? And that's where you get the forward PE analysis that you see in front of you. So we see how it's affected over the last 30 years, that it's gotten over a standard deviation above and well beyond that twice. And it's gotten below it once. So it's been really cheap. Now we're coming on to a third period of time where we're more than one standard deviation from the center. So that's valuing the overall S&P 500 at around 16.6. And right now we're closer to 20. That doesn't mean that the stock market has to fall apart. It just means that things are expensive. So if things fall apart, they have further to fall. But naturally, we have to remember when the equations on earnings, as long as the earnings have the opportunity to grow, they have the opportunity to correct themselves by essentially catching up to those figures. So it's not the predictor that the market has to fall apart. It's just saying it's got further to fall if that were to fall apart.
Mm-hmm. Absolutely. And I think that's one of the key items here to take away from this particular chart, which is that valuations are a little bit on the higher side, being a standard deviation above its 30-year average. But at the same time, that doesn't necessarily predicate that prices have to fall, i.e., stock valuations have to go down for that number to get back closer to those averages. It could very well be that earnings continue to grow at a steady pace, and thereby a lot of these companies grow into those valuations, which Brian and I will be unpacking a little later. But to dovetail this conversation on valuations, Brian, why don't we move on to our next topic here, which again, which ties into the mountaineering aspect there, and look at interest rates and how the interplay between interest rates and valuations play out, and what we should be really focusing on going forward.
Well, I think that the two of them are more related than non-related. So I don't see them as separate questions, because naturally interest rates have shifted up because inflation had increased so significantly last year. Now, as inflation increased, central banks, so the Federal Reserve in the United States, the Bank of England here in the UK, and the European Central Bank in Europe, all increased their interest rates to try to slow down that inflation. This is exactly what we've seen in here, and this is where we expected earnings to slow down, because most companies have some form of debt. Now, we haven't seen that slow down in earnings so significantly for a few reasons. Majorly, it's because most large companies' debt is longer-term debt. So if you put this in the concept of an individual, if an individual's only debt is a mortgage and it's a fixed mortgage over 30 years, raising interest rates is not going to affect them in any way unless they sell their house and buy a new house with a new mortgage. So large companies that have long-term debt, 10, 20, 30 years, haven't had to roll it over. And so it hasn't affected them in any way, shape, or form. Now, the analogy that Cam is getting at with the mountains is that late last year, most everybody was pricing in several rate cuts for 2024. So essentially it was increase interest rates. Now, once interest rates are increased, inflation goes away, and now you can bring the interest rates back down to a lower level. So there you see the increase in the interest rates, and the expectations were 7 rate cuts at the beginning of this year. Now we've gotten down to 2 potential interest rate cuts and several people talking about none. The controversial one, which we'll come back to later, is that some people are saying the earliest we'll see interest rate cuts will be November. And November happens to be when we have an election in the United States. So naturally, a rate cut could potentially make a lot of things cheaper and stimulate the economy. which will bring about accusations from certain political parties that the whole Federal Reserve is rigged to help the election. That is not true. What it really comes down to is that you can't decrease interest rates until inflation is certainly gone. And doing it too early can bring about major issues, as it has in the past.
And I think, central banks across the globe probably don't want to be seen as, making the same mistakes as the 70s and 80s, which we'll get onto a little later. But essentially, if I summarize, Brian, from your takeaway there, we're slowly shifting into the higher for longer camp for interest rates potentially. Would you agree with that assessment? And if so, how does that impact, policy going forward and potentially the stock market?
So Powell told us that we were going to have higher for longer last year. Nobody listened. The markets figured he would decrease and surprise everybody. Now, all of a sudden, when he's saying higher for longer after 6 months of keeping things the same, we're finally believing him. And the markets are actually equating. That's why essentially the long end of the curve is not as inverted as it was before, which inverted just means right now you can still get a CD for 1 year out at a higher interest rate than you could actually buy a 30-year bond. We'll explain to you later on why we're still buying those 20 and 30-year bonds, even though we're getting less interest than that 1 year bond. But the prices of those 30-year bonds, those yields, have gone up, which means we've got less of an inversion at this point in time. So the main reason is that people are finally listening to what our central governors are saying instead of what they would like to see happen.
Interesting. I guess if we move along to our next topic, which we briefly touched upon, which is the fact that yes, valuations are high, but earnings are actually coming through quite nicely. So if we move on to our next slide here, I think the headlines that have grabbed everyone's attention as of late have pretty much been the Magnificent Seven. I think you can't have a conversation these days without the Magnificent Seven coming up in some way, shape, or form. So first of all, Brian, why don't we unpack what are we looking at here when it comes to this chart, and particularly whether that concentration in just these select few names driving the overall market higher is potentially a bad thing, and are we going to be seeing a broadening out of the rally, i.e. will the rest of the 493 potentially contribute something towards the latter half of the year or going forward?
Well, let's first define a few things. The Magnificent Seven is a jargon piece that we love to use in the finance industry, but basically it's the 7 big tech names in the United States that you probably all know. Your Amazon, your Google, your Facebook, which is now called Meta, your Microsoft, NVIDIA, Netflix. Essentially these 7 stocks have really driven 64.3% of the earnings for the S&P 500. So essentially, if it weren't for those companies, we would be negative when it comes to earnings growth as the S&P 500. And that is important, and it's driven great returns because what do the Magnificent Seven make up? 30% of the S&P 500?
It's closer to 37, 36, but we'll
36,
go
37.
30. Yeah.
Mid 30% to L's on there. And therefore, if they're doing well, essentially the entire index will do well. If the other 493 are kind of just barely moving along, it's not going to affect things in a big way. And that's important because they've become almost too big to fail in certain regards. There's a lot of talks from regulators and the likes, and that will probably be our next big moment that we really see something move and shift that changes the breakup of the S&P 500. We've gone 16 years where growth has been in favor, and it's mostly been driven by these 7 stocks. It used to historically be that it would shift from growth to value companies every 6 years. It's not to say the other 493 are value companies. It's just to say that these are heavy growth companies, and that's not going to stop anytime soon. Now, even when you're talking about regulators potentially breaking them up, this is the debate that I have with Cam. I see it as being the same as when AT&T and when Standard Oil got broken up by the government. Essentially, that would be accretive to the valuations of all the underlying companies. So don't be fearful of the conversations, the newspaper articles that would state, this regulator or this government would like to see them break up those different types of companies. I see that as a great thing for the overall market. But at the end of the day, this side of the market, the Magnificent Seven, are not correlated to the overall economy in the same way that the other 493 might be. And that's a good thing. That's that driving force that has held up the stock market despite this last year being a little cooler than we would have liked to in the overall general economy.
Mm-hmm. I think then essentially the next question or the question that many of our clients and many in the audience here may have come across at some stage is, you know, whether this is similar to the .com, Brian, or, you know, are we entering into a bubble territory in regards to these, you know, 6 to 7 companies that are really driving home that earnings growth? And I think it's safe to say that, you know, NVIDIA is probably the poster child of that. So if we move on to our next slide here, and first of all, why don't we unpack, what are we looking at here? And B, why this isn't another .com bubble, etc.
If you never thought that Cam was a quant before, you can see it right here displayed nice and easily. Essentially, what Cam has highlighted for us is the net income growth. So the earnings growth of NVIDIA, as he pointed out, the kind of most described company as being a poster child for a bubble. But what you'll see is they've gone from net income of $4 billion to $29.7 billion in just a year. That is astronomical growth that goes alongside of the stock. So if they can continue any kind of growth that's close to that, it is not anywhere near a bubble. I.e., this is not like the tech crisis, because these companies are making an astronomical amount of money. The only correlation that you can make towards it is whether the growth can continue. And the main aspect is there's several other semiconductor companies that are trying to dethrone NVIDIA of being the king of semiconductors. Whether they will or not doesn't matter to us as long as we have a nice diversified portfolio, as long as NVIDIA doesn't make up too big of a part of our portfolio, because we can never say whether a company will continue to be at the top forevermore. But this does show to us why this is not in any way, shape, or form a bubble of the overall marketplace.
Mm-hmm. So essentially the takeaway there is that a lot of these tech-heavy companies do actually have the revenue and the income to back up some of those valuations. And as you pointed out, Brian, you know, the $1 million, if not $1 billion question going forward is, can they sustain that growth, right? Can NVIDIA do another 6x of going from 4 billion to 29 billion of net income, and thereby the price, you know, goes up 6x? Again, valuations don't strictly work off that in a straight line, but it goes to show that there is substance behind a lot of that growth in some of these names. And then the real question going forward is, can they continue on that pace?
I think the main takeaway that anybody should have on this is, if you take a look at that book, Chip Wars, gosh, Chris, I can't remember Chris's last name. Wonderful book. Basically, diversification in this sector is going to be key. There is not going to be just one winner over all times. Apple's proving to have a little bit of a hard time, and they're going into the semiconductor space to potentially try to take some market share. But we've got a big player here in the UK. We've got a great player out in Taiwan, a ton in America, and they're all going to be playing for this segment. So if you do have a large position in NVIDIA, this might be a little bit of a time to take a little off the table, diversify it around, because the actual space is grand, it's going to grow, but there's plenty of companies that are in that segment.
Exactly. So it won't be a winner takes all sort of situation, but somewhere in the middle. Perfect. Just doing a quick time check here to see that to make sure that we have enough time for our Q&A section. So moving along swiftly, we've unpacked a number of things, Brian. But what does this actually mean? What does this mean for our audience? What does this mean for our clients? And then if we jump along to the next slide, particularly, I think one of the key aspects that you and I have been having several discussions on is essentially currencies. Some currencies have been particularly volatile compared to others, but essentially the talk of the town has really been the resilience and the strength of the US dollar. So why don't we unpack, first of all, what is this chart that we're looking at here, and why has the dollar been so strong?
Well, the dollar, this is basically the dollar index. So it's looking at it's comparing itself against other developed markets in a basket. So this is a good way to look at an overall metrics if you're not trying to just identify dollar to the pound or dollar to the euro. You're trying to look at the overall strength of the dollar. And you can see that we've been up over 5% this year, Cam. Is that about right?
Yep, that is about right compared to the basket, yeah.
Now, this shouldn't come as a huge surprise, because as I was alluding to earlier, everybody on the street was expecting interest rates to go down at the beginning of the year, 7 potential rate cuts. Now, the typical analyst on the street's saying 3 rate cuts. And you've got plenty of analysts that are saying 0. Now, if we have higher interest rates in the United States, where the economy is actually still going quite strong, and inflation is a little bit under control, not as good as Powell might want it, but it's doing decently. When you look at a country like the UK or Europe, where the economy is weak and inflation is a little bit lower, there's more of a demand to reduce interest rates. In the UK, they're about the same level as the United States. In Europe, they're lower. If all of a sudden you have lower interest rates, i.e. the GBP going down compared to the US dollar, what we're going to really see is we're going to see a flow of assets going to the higher interest rate, because they can go ahead and cover that risk in a carry trade in any way, shape, or form. Last year, the biggest carry trade was Japan and Mexico. So borrow in Japanese yen and go ahead and lend money in Mexican pesos, hedge yourself back, and just collect the coupon. Now, this is not going to be the biggest carry trade in the world, but it will try to push flows the more they bring down interest rates in Europe and the UK, which will hopefully stimulate their marketplaces. So this is what's really driving the US dollar in the last 6 months. Once they catch up and lower interest rates to get to the equivalent of what the UK and Europe might have, then hopefully we can see a little bit of a rally back in global currencies, because naturally too much strength in the dollar will slow down the US economy. If the US economy sneezes, the whole rest of the world gets a cold. So we don't want this to be a long-term function, but it's certainly going to be a function until inflation is back down at a 2% level and the Federal Reserve has confidence that it's stuck at a 2% level.
Mm-hmm. And speaking of inflation, which is a very nice segue onto our next slide here, inflation, as you mentioned, Brian, whether it's here in the UK or in Europe or even the US, it's made considerable progress from the absolute highs that we had last year, where a lot of the economies were digesting the shock of the invasion Ukraine and the effect on the energy supply there. And it has moderated to some extent here in that regard. But why would you say inflation, particularly in the US, has been very, very stubborn to get to that 2% figure? And how does that potentially support, interest rates and them being kept higher for longer, potentially?
Well, depending on whether you're looking at CPI, which is what the Federal Reserve is going to look at, and their governors are going to look at the closest, which excludes a lot of commodities, or whether you're just the consumer that's going into the grocery store, you might have a different view on inflation. Prices in the grocery store have gone up astronomically in the last year. The 3 items in the grocery store that have gone up the most: number 1, chocolate; number 2, coffee; number 3, olive oil, right? It's a weird mix, but it makes for a lot of miserable people, and that's why it might actually affect some of these 70 elections that are going on around the world. And that's why people are stuck talking about it. Where I'm really concentrated on is some of the instability that could come from higher oil prices. We had a little bit of a spike up there at $90 barrel oil. At least it's alleviating a little bit now, all the way down to supply chain issues through 3 of the major straits of the world. We still have a little bit of a bottleneck because of some global warming and El Nino effects over there in the Panama Canal. We still have a few pirates down in the Suez Canal, and there's always that threat of China going into Taiwan in the China Strait. Those are 3 of the most important areas of supply chain issues. So commodities can be affected significantly by those. And naturally, we're constantly talking about those because we really need to just get back to those normal times of 2% inflation if we want interest rates to get right back down to those relative levels.
Mm-hmm. So essentially, to summarize there, Brian, a lot of the progress that inflation has made in getting towards that 2% target has really been driven by the energy complex, i.e., oil and natural gas coming off those absolute highs. But naturally, as you mentioned, that can very quickly reverse. And if we move on to our next slide here, which compares the trajectory that inflation has taken, in the last 2 to 3 years versus the 70s, it starts to paint a bit of a trifecta there. And what are your thoughts, particularly on inflation in today's environment versus the 70s and 80s, and what's different versus how inflation played out in the 70s and 80s, and could we be looking at something potentially similar?
Could we? Of course we could be. Hopefully we're not. And that's where I'm happy to see interest rates staying higher for longer. Essentially, these higher interest rates will hopefully stymie some of the growth and essentially reduce this inflation in that second jump that we saw back in the 1970s. Now, the reality, we'll have to wait for it. We'll have to wait and see if these things replicate on there, because naturally, every time that somebody demands a higher wage so that they can keep up with inflation means they're continuing to create that demand, and we end up having demand-driven inflation instead of supply-driven inflation. Most of our problems over the last couple of years were supply-driven. But if the consumer stays too strong and continues to buy, and all of a sudden everything increases because the demand stays too high, it can go ahead and shift into that second jump. And that's the part that Powell has to reflect upon, the fact that he started too late at increasing interest rates, and therefore he'll have to stay with higher interest rates longer, and that will be a good thing.
Mm-hmm. I think one of the most sort of existential events that happened in the 70s that may not potentially play out quite like that in today's environment was the oil embargo crisis of the 70s and 80s. Back then, naturally, as you and I both know, Brian, and we've had several discussions on, the US was actually a net importer of crude oil back in the 70s and 80s, and naturally that situation has been turned on its head with the shale revolution, and to many people's surprise, the US is actually one of the largest exporters of crude oil going forward. So, even if we do have some potential geopolitical risks out there when it comes to the supply of crude, I don't think the US personally will be affected to such a great extent, although the same can't be said for Europe and the UK, which is why I think potentially inflation may take a diverging path, between the US versus Europe and the UK. But as you mentioned, we'll have to wait and see to see how that plays out.
It goes back way further. The dominant nation in our times has always been whoever controlled the energy. So you think of the Dutch, they controlled the wind. The English, they controlled the coal. The Americans, they controlled the oil. And now, essentially, the question becomes, how does that evolve into the future? Energy independence is going to be the most important aspect of whether a country can go ahead and thrive and become one of the majors out there. And this is going to be a little bit of a speed bump in the way.
Mm-hmm. And sticking on that same line of thought and staying with the US theme there for a moment, why don't we move on to the US consumer and why, despite all the incessant predictions that we've had for over a year now that a recession is just around the corner, how has the US consumer remained so strong, Brian, first of all? And B, does that still have room to continue supporting the US economy going forward?
This ends up looking like my heartbeat during a workout. It's explaining that just a little bit, Cam. Basically, all you're looking at is what the unemployment rate is, and essentially that huge spike up isn't just right there 3/4 of the way through my workout. That is actually just COVID right there, where naturally unemployment went through the roof and then came right back down. Now, oddly enough, when interest rates go up, jobs are supposed to be cut. We spent all of last year watching newspaper article after newspaper article. I think there were over 250,000 cuts just in Silicon Valley. And it looked like unemployment rate should be going up. There's been a lot of explanations why it hasn't. The one that I find the most entertaining is that supposedly a lot of people in the tech universe and the engineering space during COVID were taking multiple jobs. And when they were taking multiple jobs, essentially, as they were forced to go back into work, it showed up on the front page of the newspaper that XYZ company was cutting this number of employees, but because they had multiple jobs, they weren't unemployed at that point in time. Whether that's true or not, we'll always just have to speculate, but it makes for a good story. So let's go with that. That being said, I think it has more to do with just long-term demographics. We've been talking about it for decades, that the baby boom generation was going to finally retire, and that was going to mean that we were going to have a smaller working pool. I'm just going to use 2016 as a metric. In 2016, 71% of Americans were actually part of the working class, and 29% were either children, retirees, disabled, or unemployed. That's the number that really matters, is the 71% paying in and 29% taking out. We're down to closer to 66/67% is part of the working class. So 4 to 5% of people haven't necessarily lost their job. They've retired. They've done what we were talking about them doing for years. And that basically means there's more of a constraint on the number of people that have jobs out there. They're paying into the system. Well, if companies have the same demand for those for jobs as they did a short 8 years ago, that means there's the opportunity for people to move around without having to worry about unemployment. So I think we have a demographic issue. We should be following suit with what Japan had as issues for the last 10 or 20 years, because our demographic shift is about 10 years behind Japan. What did they make as a mistake? They didn't bring in enough immigrants to fill that working class. What are most of these elections about this year? Immigration. So if we don't want to see huge economic problems because we don't have enough people working in the jobs, we probably have to increase our immigration instead of decrease it to support the overall baby boomer generation that's all coming into retirement right now.
Mm-hmm. And it's an excellent point there that you bring up, Brian. Just doing a quick check here for time to make sure we have plenty of time for our Q&A function. So we'll whistle past the next few slides in swift fashion to make sure we have enough time for the Q&A. But I just wanted to carry on that tangent of thought there, Brian, on the resilience of the consumer. And one of the aspects that many people have been caught up on is the fact that there was a lot of excess savings that were built up during the pandemic because of the stimulus checks, etc., that the government paid out to each and every US citizen essentially, which in normal times delayed that sort of pain that's typically felt with higher interest rates, etc. So I'm just going to unpack the chart here of what we're looking at, and then Brian, why don't you give your thoughts on how that excess savings has delayed the recession, or potentially has that even staved off a recession completely. So just for the audience here, what we're looking at is a chart which showcases the personal savings rate as a percentage of disposable income on an annual basis. And as you can see there in the COVID period, essentially that huge spike up was essentially those stimulus checks that were being mailed left, right, and center, along with a lot of the loan programs that were being rolled out to various businesses. And then as we can see here, essentially those excess savings have been drawn down steadily over the last 2.5 years or so, which many people, and I know you and I have had this conversation several times, Brian, that has kept the US consumer going. And then the question remains is, when those excess savings dry up, will that then inevitably cause a delayed recession, or can the US consumer continue to keep this economy afloat? So what are your thoughts there now that I've unpacked what we're looking at here on this chart, and what do you think of that going forward?
The street likes to talk about it as either a hard landing, a soft landing, or no landing, which is quite a grim thought, especially if you're scared of flying. Now, essentially, last year we were talking about we're either going to be hard landing or soft landing. Now it's soft landing or no landing. So this is not supposed to be a grim response. It's supposed to be, why is the action that the Federal Reserve is putting into place not affecting the economy like it historically should? And that's what Cam's really alluding to. It's got a delayed approach because you don't foreclose on your house when you've got money in your bank account just because you aren't earning as much as you did before. So if you've got the money in your bank account, you've got that surplus savings, and therefore you spend that when you lose your job before you lose the house or lose the car or anything else. And we're seeing some of those numbers, i.e. Defaults on credit cards and defaults on car loans effectively shift up. The easiest company to look at is Capital One. They have a ton of both, but the savings rate gives us the other side of things, the M1, the M2, and the M3. Some of you have heard me go off on tangents on each of those. This is a good thing, a bad thing for those individuals, but a good thing for the overall economy, because it means that inflation will go down even further if they can keep these interest rates high enough before the economy hits either a soft landing or, even worse, a hard landing. So I do believe that the overall economy can actually have a no landing scenario, but a decreased savings rate, which will bring about essentially lower inflation, i.e., we can have our cake and eat it too.
It's an interesting take there, and I think, as you mentioned, the street is pretty divided on which outcome, but as always, we'll have to give it time to see how that actually plays out. We're going to skip past this slide here just for the sake of time, but again, everybody will get a copy of the slides after this call, so you can go through it in your own time. But we touched upon elections, Brian. Elections are pretty much the decisive headline-grabbing item here for this year. As you mentioned, there's 70+ elections, and you know, I'm not sure how many more are still yet to take place. But essentially, regardless of how the politics play out in November in the US in particular, should our clients be concerned or somewhat cautious on who is actually in the White House and how that impacts the stock market potentially?
See, I know Josh isn't here when we're not going into Indonesian, Malaysian, or Indian elections, anything that would be off the beaten cuff. So we'll have to save that for next time. We'll just go straight into the U.S. elections, because that's all anybody wants to talk about. There's going to be a lot of misinformation out there, and this is to where it doesn't matter if you're Republican or Democrat. What you can see is the stock market's performance ends up being great during all presidencies. I haven't seen a big difference on either side, but both sides seem to allude that they end up performing much better than their opposition. So we don't have to worry about our overall portfolios. Naturally, both sides have a little bit of different stance. You know, Trump naturally having more of a stance against free trade. That might see a little bit of a weakening in the US dollar, but a strengthening in certain assets in the United States. So we could see some big shifts over there, but the overall stock market will not be affected in those types of ways. The debate really should come down to what their policies are, not how they're going to affect the overall economy, because both sides will essentially bring about different views and different things that will help the stock market.
Perfect. Excellent summation there, Brian. I guess to summarize essentially and give some context here to our audience as well. So we've unpacked a few of those key items of, you know, what we're looking at, what's going on with the economy and the market. But then how does this impact our clients' portfolios essentially? And there's three key aspects here that we've touched upon. I think Brian has alluded to the US centric bias there in the beginning with the currencies and a lot of the earnings growth coming from you know, the S&P 500 segment there. And we briefly touched upon the energy transition in some of our previous webcasts. But I want to focus on the increasing duration aspect here, Brian. And why don't you give our audience a little bit of context here of, A, what does increasing duration actually mean? And why are we all of a sudden actually a little bit more optimistic on bonds?
Well, in a simple fashion, if we think about bonds, we're just lending money to somebody. It could even be a government, it could be a corporation, it could be a lot of different places, but we're letting them borrow money. And whenever yields go up, our price of our bonds goes down, and same vice versa. So those are the basics of a bond. Last year, we had an inverted yield curve, which we still have, which means that we're getting higher interest rates on the short end of the curve rather than the long end of the curve. If you let somebody borrow for 1 year, you're getting 5.5%, whereas if you let them borrow for 30 years, you're getting what, 4.7, 4.8%. So you're getting less for lending money longer term. That doesn't make complete sense. But what's that expectation? It's just the expectation that interest rates are going to go down. That's how we can say how many interest rate cuts the street is expecting without having to go out and talk to every single analyst or every single trader. We can see how it reflects on that yield curve. Now, last year, as interest rates were going up, we wanted to be on the short end of the curve because that has the least amount of risk as the value of the bonds go down. Now, this year, at a certain point in time, we know interest rates are going to go down. We just don't know when. And that's to where by owning on the long end of the curve, so those 30-year bonds, 20, 30-year bonds, we can take the ride on the other side of seeing the values of our portfolios go up as interest rates go down, because you'd rather own a 5% bond than a 4% bond. Therefore, the difference comes across in the price. Now, let's back up a little bit for how the stock market reacts to the economy. Now, if the economy slows down, essentially the stock market is normally correlated and therefore will come down somewhat with it. The only way that essentially with inflation being combated, the Federal Reserve can stimulate the economy is to lower interest rates. Not the only way, but the biggest way. So if they decrease interest rates, all of a sudden, even though our stocks have gone down in value, our bonds will go up in value. So we're not saying this, by buying 30-year bonds or 20-year bonds, this is where we're going to make money today or tomorrow. It might take a year or so, but what we're doing is we're building a barbell strategy that we end up having something that the day our stocks no longer do as well, our bonds are going to do really well. Now, what Cam's highlighting here is he's basically saying, if we had a 1% move either up or down in interest rates, how we'd expect a 30-year bond to perform, according to JP Morgan. So if interest rates have to go up because they have to fight inflation some more, we'd lose 12% on there. But if they go down by 1% because they need to stimulate growth because the economy is doing poorly, but inflation's contained, we'd expect them to go up 24%. Historically, what we're always looking for are opportunities where we have twice the upside to 1 time the downside. Hopefully, next year we're complaining that we're still getting 4.8% while we could get 5.5% from a 1-year CD, because that means the economy has stayed strong. That is what we're cheering for. What we want to make sure of is that we have the insurance just in case the economy doesn't stay strong. And that is why we're buying these 30-year bonds, because they'll complement our equity side of our portfolio.
Mm-hmm. Great summary there, Brian. Now we're just going to land the plane here, and speaking of landings and no landings, and moving on to our Q&A section here. So as always, please feel free to post your questions in the chat function. It has been enabled. I got a message from one of our panelists that it was disabled. Both the chat and the Q&A function are enabled, so please post your questions there. We'll give it a few minutes for some of those questions to come through. And as always, thank you very much, Brian, for that excellent insights there. Just for our audience, after this call, you will get a sort of follow-up. You'll receive the presentation as well as the recording, so you'll be able to go through it in your own time, and also look at a lot of the topics that we weren't able to cover in depth here just for time constraints. So again, we'll give our audience a few minutes here for them to post their questions.
While we're waiting for those questions, why don't you go into the appendix? I mean, let's see. What are topics we wanted to talk about?
Absolutely. I think one of the topics or discussions, Brian, you and I have had many discussion on is looking at small caps potentially. I know, historically they do tend to perform quite well when you get a synchronous recovery across the board. But some of the questions, I guess, that may not be on our clients' minds, but are on my mind, is why are we slightly underweight small caps right now, and potentially when could that reverse?
That is a great question, and it is coming due this summer, where we're going to really start to recognize how that's going to behave. Small caps tend to have shorter term debt than large caps, and small caps tend to also have more debt right now than large caps. So they're going to be more impacted by the overall increase in interest rates. And that's what we've really seen. We've seen the devaluation, and a lot of that debt comes due this summer, June, July, August. As that debt comes due, we're going to find out As Warren Buffett puts it, who's out in the ocean swimming naked when the tide rolls in? We're going to find out which companies can go ahead and roll out new credit without having to default and which ones are going to fail at this point in time. If we get essentially a decrease in interest rates at some point in time in the near future, and we have some of those failures in those indexes, we're going to have that perfect place that we can pick things up at a cheaper price. We've also looked at, for some of our clients, opportunities at buying small caps that have good free cash flow and very little debt. So there's opportunities out there that we're starting to play in. But naturally, we need the recovery to start happening, and we need that debt cycle to take place before we start trying to pick off the bottom.
Good insights there. All right, looks like sorry, good, Brian?
Good. Sorry.
No, I was just going to say, it looks like we've done such a thorough job that none of our audience have any questions. But as I mentioned, everybody will be getting a recording later on for you to view in your own time, as well as the presentation here. So you'll be able to unpack a lot of the material in your own time and come back to us with questions later on if you do come up with them. But I think we'll wrap it up right here.
Yeah,
we've got one question.
Yeah, we've got one great question. Robin asked, in terms of bond investment strategies, is there a difference in the approach for shorter term versus longer term investors? i.e., is there a different strategy for those who are nearing retirement versus those still decades off from that need to use the investment returns for retirement? That is a great question, Robin, and thank you for asking it. Essentially, yes, there is, but it's not going to be as drastic as you might think. In other words, the only differential that we're going to have for somebody that's nearing retirement is making sure that we have enough in short-term bonds to make up their short-term cash flow needs. All of the rest of it, we want to be on the longer end of the curve. And I'm using longer in kind of a mix of 7 years plus. To where it's going to be affected more by those shifts in interest rates. Anything 3 years or below is basically going to act like cash. And therefore, we might get a little bit of a jump, but nothing big to speak of. But we want to marry those two aspects. How much cash flow we need, or cash we need for short-term projects. Because like I said, I'm hoping that we don't see that 24% next year, because that means the economy is strong and the equity side's doing well. But that means we need to get that interest from someplace. When you say bonds, are you referring to bond ETFs or something else? That's a great question, Sam. So it can be one and it can be the other. For most of our clients, when we're buying 30-year bonds, I would rather buy it in a bond ETF. The main reason is we're getting, first of all, lots of diversification, and second of all, we're getting a lot more liquidity. For some of our clients, we might be buying some individual bonds in there so that we can go ahead and net out exactly what those cash flow needs might be. So it depends on the strategy for each client, but a lot of you will see a few names that are ETFs, exchange traded funds, in there, because that will marry with the equity side of the portfolio.
Well, it looks like that's all the questions, unless we get a frantic last minute question that pops up. But again, I want to thank Brian and Nisa for their insights, excellent insights as always. And I want to thank our audience for tuning in. And yeah, thanks everybody for joining, and we wish you a wonderful rest of the day.
Thanks for hosting, Kim. Thank you, everybody, and have a wonderful day.